Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Well, here's where we're going to find out if size really does matter, at least as it pertains to your position, as it pertains to options.
That's a good title.
Kevin
I should have
Mattress.
put that in my title. Oh my goodness.
Bet you wondered where I was actually going with
Right.
that.
Yeah, I was listening intently.
Position sizing, that's what we're talking about.
Yeah.
And that's a term that you don't really hear a whole lot about unless you are a student of options. So for
Right.
those who really don't know, what is it and why is it important?
Yeah. Well, it's just important to trade with the right amount of money. I think it is one of the most critical, important elements to successful options trading. Nobody talks about it, which is why we're going to be talking about it today. But long story short, if you put in too small of a position in your options and it turns out spectacularly, it's not going to matter. It's not going to make any impact on your account. But then if you put in too much into your options and your trade blows up on you, it's going to put a sizable dent in your portfolio. And I've seen too often where it puts an insurmountable dent in somebody's portfolio. So this is something that people, I just don't believe, are paying enough attention to. Now, there's a lot of ways that you can determine what the correct position size is. It just so happens that the way I do it, I believe, is the best way, and that's what we're going to be talking about today.
All right, so is there a target amount of money that people should keep in, as far as a position is concerned in their portfolio when it comes to this kind of stuff?
Well, let me just see if I can digress just a bit. For me, I believe that every portfolio should have a portion allocated to options. And I believe that you should probably limit it to, let's say, 20% of your portfolio. But anyways, talking about position size, here is the way I like to do it.
Okay.
So you first want to take a look at your own trading habits. So let's just say that your typical position size is $10,000 in a stock, right?
Okay.
So if, let's say, a stock you're looking at is trading at 50 bucks, that means you can buy 200 shares of that stock with that $10,000 you have. Now, let's say that when you put this trade on, you think to yourself, okay, I am willing to risk 10%, right? A lot of people use stops. So I'm willing to risk 10%, on this trade, which is equivalent to $1,000. Now, translating that to options, if I bought one option, right, one option essentially gives you control of 100 shares. If I bought two options, I basically now have control of 200 shares. So if I bought one option for $500, under the absolute worst case scenario, if everything were to go against me, I could lose 500 bucks. If I bought two options, which is a total investment of $1,000, if the proverbial stuff hits the fan, worst case scenario is I could lose that $1,000, and that $1,000 is equivalent to the $1,000 I was willing to risk on my stock position had I gone that route. And for me, that is one of the foolproof ways to be able to manage your risk.
So under the worst case scenario, you can lose money.
Yeah, worst case scenario, of course you can lose, but worst case scenario with an option is, yes, you could lose absolutely everything that you put into it. By the way, the one thing I do want to say, one thing that I see investors do when they decide to get into options, usually for the very first time, is they'll think to themselves, all right, I'll put $10,000 into a stock. Maybe I can put $10,000 into an option. Horrible idea. So instead of putting as much money into an option as you would into a stock, you put as much money into an option as you are willing to risk on a stock position. But for options, you always want to be cognizant of your worst case scenario. Nobody gets into an option believing that they're going to lose all of their money. Nor would you want to stay in a losing position if you did, while your option is frittering away. But like I said earlier, you want to invest under the worst case scenario. Always be cognizant that, wow, if this black swan event happens, and usually your worst losses are these unforeseen circumstances. So you want to pretend, okay, if something horrible happens to me, what's the worst case scenario to me? And like I said earlier, this is a foolproof way of managing your risk and ensuring that you never get into trouble. Now, if you're trying to, spend as much money on your options as you would typically be willing to risk on a stock position, sometimes you may have to split up your options. So let's say instead of getting two $45 calls, for example, you may have to buy one $45 call and one $47.50 call. The trick, though, is to buy as high of a quality option as you possibly can, and try to get as many options as you can that are as close to the equivalent of how many shares you could buy in a stock, and stay within that predetermined risk amount. It seems like a lot, but it's actually quite easy to do. And again, like I said, foolproof. You will never regret your decision, and it's a way to make sure that your risk doesn't get out of control.
Any exceptions to those rules?
Always exceptions to every rule. The exception is this. Sometimes you are going to be forced, or you feel like you need to spend a little bit more on your options to get the really good quality options that you want. And on a limited basis, this is okay as long as you get a ton of time in your options, because if, let's just say that trade blows up, but you have a ton of time on that option, options don't go to zero overnight. If you have 3, 4, 5 months of time on your options, there's always going to be time value there. So you'll have time to react, and you'll be able to salvage that position without blowing out your risk parameters. So for example, let's just say that you bought 2 options at $700 each, right? $700 each. So now I've got $1,400 on the line instead of $1,000. If something happens to that stock and your options were to go down a total of $1,000, I still may have some time left on those options, and I still have a value of $400 left on those 2 positions. But if I see that my total value on those options has dropped by $1,000, get out. Get out. It does take discipline to do, but if you do it, you've once again limited it to the amount of money you had planned on risking in the first place. And once again, I know I've said it over and over, but it cannot be said enough, you have complete control over your risk management. It's absolutely critical, because with an option, it is absolutely imperative that you live on another day, because if you are wrong in a stock, and look, you're going to be wrong in stocks, that's part of trading. You need to be able to reserve that critical mass so you can put your money on another bet and another bet and another bet. That is why you got to manage your risk.
So bottom line, apparently size can matter.
Size does matter. Nice way to wrap that up, Terry.
Position sizing is what we talked about. And if you're not at our website, Zacks.com, watching this video, get on over there and get right to the options section of the website, because there's where you can find out more in print about position sizing and other information to help you know your options. With Kevin Matris, I'm Terry Ruffalo.